Hi, welcome back. In this session, I'd like to talk about what we've seen so far in markets in 2021. For the most part, stocks have been behaving pretty well. You've seen stock prices go up. But the big story of the first quarter of 2021 has been the steep rise in treasury rates, especially at the long end of the spectrum. The T-Bond rate, which started the year at 0.93%, rose briefly above 1.7%. And as this has happened, while stocks overall have done well, there's been a shift away from the winners and losers of last year to new winners and losers. In fact, what we're seeing are the stocks that were the losers of 2020 are increasingly the winners of 2021, which has raised talk of a rotation in markets, which really means nothing because it just is a description of what's happening to stocks. In this session, I'd like to talk about the relationship between interest rates and value. Now you might say, I know it already, it's pretty straightforward. It's not that straightforward. We're going to talk about the nuances as to why when rates rise, you cannot automatically jump to the conclusion that stock prices will decrease, and how differences occur across companies when rates go up. So let's start by first setting some long-term perspective. Much as we'd like to think about rates as having gone up, if you look at it from a long-term perspective, rates are now still at historic lows. This is a graph that looks at the 10-year T-bond rate and the 3-month T-bill rate going back all the way to 1928. You can see the spike in the 1970s. And for those of you who say, don't worry about inflation, remember that spike. And the decline in rates since, especially since 2008, where rates have been at historic lows. Of course, at the end of 2020, the T-bond rate had hit 0.93%. The T-bill rate was at 0.09%. They were at historic lows. Now in 2021, we've seen a little bit of a resurgence in those rates. But again, keep it in perspective. The 3-month rate has done pretty much nothing. It stays close to 0%. But the 10-year rate, which started the year at 0.93%, is now up to almost 1.7%. The 30-year rate, 1.66%, is up to 2.38%. Even the TIPS rate, which is minus 1.08%, has become less negative. Something clearly has been going on in these 12 months. And while we might have different entities to blame, it takes a little digging. So let's talk a little bit about the entity that's usually blamed or credited whenever rates change, the Fed. I'll be quite honest, I'm sick and tired of the Fed obsession that's taken over markets. To every question about interest rates, the answer seems to be the Fed did it. Really? Why have rates been low over the last 10 years? It's the Fed. I know that comes easily to many people, but let's dig a little deeper. Is that the real reason rates have been low over the last decade? To try to answer this question, I compute what I call an intrinsic risk-free rate. You're saying, what the heck is an intrinsic risk-free rate? It's basically a sum of inflation and real growth. And the theory is very simple. An interest rate can be broken down into expected inflation and an expected real interest rate. And over time, real growth and real interest rates are connected, even if they're not equal. So what I've done here is taken each year, the inflation rate in that year and the real growth rate in that year, added them to come up with an intrinsic risk-free rate. In this graph, I've graphed that intrinsic risk-free rate against the actual T-bond rate. Now, you don't need to be a statistical genius to figure out the two move together. In fact, take a look at the last decade and you can see why rates have been low. Inflation has been lower than it's been in prior decades, 1.76%. Growth has been anemic, 1.7%. You add low inflation to low growth, you're going to come up with low risk-free rates. Has the Fed an effect? Of course. It has an effect through the influence it has through the Fed funds rate. It has had an effect through the bond buying it's been doing since 2008. But it is a secondary effect. It influences rates. It doesn't drive them. And in 2021, you clearly cannot point your finger at the Fed for what's happened to rates. In fact, what's happened in 2021 should let people shed the delusion that they have that the Fed somehow sets rates. Over the last 12 months, everything we've heard from the Fed, from the top all the way down, is that they're going to leave rates low. But while they've been saying it, guess what rates have been doing? They've been rising. And why have they been rising? Very simply because people see higher growth in the economy. That's a good thing, right? The economy is coming back. And perhaps higher inflation. That's not such a good thing, but it might be factored in as well. In fact, as you look forward, let's think about inflation and real growth. If the economy comes back stronger than expected and inflation is strong, in my view, there's nothing the Fed can do to keep rates low. I mean, after all, the Fed doesn't set interest rates, sets a Fed funds rate, which none of us ever gets to borrow at. And through the Fed funds rate, it influences other rates, especially at the short end of the spectrum. But there are two problems that the Fed faces. One is the Fed funds rate is close to zero. So there's nothing it can do to lower that rate by very much. There's not much room to run. And on the other side, the Fed's power comes from the credibility it has to signal to the market. And if it loses that credibility, markets will stop listening to the Fed. It's happened elsewhere. The Japanese central bank has become a hapless bystander because nobody believes it anymore. Right now, if you look at the Fed's own assessments of what 2021 is bringing, they're predicting pretty strong growth, 6.5% in the most recent prediction. And they're predicting inflation coming back to 2.2%. And to me, those predictions are incompatible with rates staying at 1.5 or 2, or even the 2.5% that the Fed claims is its ceiling. We'll wait and see. But while we wait and see, let's think about what stocks have been doing. While rates have been going up, stocks have continued to go up. But there's been a contrast between stocks within the market. To see this contrast, I've taken two very widely followed indices, the S&P 500 and the NASDAQ, and looked at how they've behaved over the course of this year. The S&P 500 is the 500 largest market cap stocks. There are some big tech companies in it, but the NASDAQ is more purely a tech index, though it has some very large tech companies in it as well. In January, the NASDAQ outperformed the S&P 500, so it looked like more of the same because if you look at 2020, in fact, the decade leading into 2020, the NASDAQ had beaten out the S&P 500. Tech had been beating the rest of the market. So after January, it looked like more of the same. But in February and March, you've seen the S&P 500 come back. That is the rotation we've been talking about. If you look at sectors, you see the same kind of rotation happening. The best performing sector in 2021 has been energy, which was among the worst performing sectors of last year. Among the worst performing sectors of 2021 has been tech, one of the best performing sectors of 2020. I won't go overboard and argue that there's been a complete reversal, but clearly there's been a shift away from what happened in 2020. In fact, there's another dimension on which you can see the shift. I broke stocks down based on price to book, a very simplistic way of thinking about value versus growth stocks, value stocks being low price to book stocks and growth stocks being high price to book. In 2020, we know who won. Growth stocks won hands down. High price to book stocks outperformed low price to book stocks tremendously. Well, the tide seems to have turned. Though again, not as egregiously as some people claim it has, but it's shifted. At least so far in 2021, it looks like low price to book stocks are doing better than high price to book stocks. You're saying, what's the link with interest rates? We'll come to that in a moment. But let's first see how interest rate changes play out in value. So this is a picture of what drives intrinsic value. You've got cash flows, and you've got a discount rate, and everything you talk about has to show up in one of those two places. In a discount rate, you have a risk-free rate as your starting point and risk premiums, either in the equity market as an ERP or in the bond market as default spreads. Your cash flows come from your growth in revenues, the margins you will earn on those revenues, and how much you reinvest to get that growth. It's kind of a generic picture of value. So let's see how interest rates play out in this picture. When interest rates go up, the direct effect, the effect that most people notice, is your risk-free rate goes up. That pushes up discount rates. But that's not the only effect. In fact, to see the other effects, you got to dig a little deeper as to what made interest rates go up in the first place. Ultimately, as I mentioned earlier, when interest rates go up, the fundamental reason can either be an increase in real growth that people are expecting or an increase in expected inflation. And those two causes can have very different consequences. If it's higher real growth, that's driving up interest rates. In addition to rates rising, here's what you should expect to see. You should expect to see revenue growth pick up at companies as the economy grows faster. And as the economy grows faster, companies should be able to earn higher margins in their revenues. So basically, you're going to have interest rates push up discount rates, but the same forces that cause interest rates to go up will also cause your cash flows to go up. If the cause is inflation, that pushes up risk-free rates through the interest rate, but you also have potentially more negative consequences. Historically, when inflation goes up, risk premium have gone up for a simple reason. Higher inflation often has also meant more volatile inflation. What I mean by that, if your expected inflation rate is 1%, there's not a whole lot of variation you're going to get around 1%. If your expected inflation rate is 10%, you'll get a lot more variation around 10%. That plays out as higher risk premium. In addition, when inflation goes up, companies can get squeezed, especially companies without pricing power. So what you will have in addition to higher discount rates is sometimes you can see your cash flows decrease as your margins compress. Now, if I had to define the consequences, clearly real growth driven interest rates have a much more benign consequence, could potentially even have an increase in value than inflation driven increases in rates. So let's summarize how higher real growth and higher inflation can affect your inputs. They both have increased the risk-free rate. No debate about that. Higher real growth will not generally affect risk premium. They might even decrease risk premium because you're in better times. But higher inflation can push up risk premium, both in the equity and the bond markets. Higher real growth and higher inflation will both push up revenue growth, but inflation will have different consequences for different companies. Some companies will be able to push up revenues more than others. Now, in terms of operating margins, when higher real growth is driving interest rates, companies may have more pricing power, improve margins. But when inflation is driving interest rates, companies without pricing power can get squeezed. In terms of investment efficiency, when you have higher real growth, investments become more efficient because you're able to generate more output and more sales from the same investment. With higher inflation, there's generally no effect, though sometimes companies can look more efficient with inflation. They have higher returns in equity, and if you're not looking under the surface, it looks like they're earning higher returns. So the bottom line is the value effect when higher real growth is driving interest rates could potentially be positive. In other words, rates could go up and value could go up. But with inflation, the effect is more likely to be negative. So let's see if this is held through time. So here's what I've done. I've looked at quarterly stock returns going back to 1960. And the T.Bond rate in this chart. Not much you can take out of the chart. There's a lot of noise in there. But here's the more productive part of this chart. If you look at the bottom, I've computed the correlation between stock returns and T.Bond rates and T-bill rates. Not much correlation with the levels, but you can see when rates increase, stocks are more likely to go down. So when rates go up, returns are more likely to be negative. You're saying higher interest rates are bad for stocks. Not so fast. If you look at the correlation between stock returns and inflation, the correlation is negative. Higher inflation has led to lower stock returns. But look at the correlation between stock returns and real GDP growth. The correlation is positive. Reinforces the point I made about the consequences of inflation and real growth for stock price value. Now, the other way I can illustrate this is earlier this year, I valued the S&P 500 index, making assumptions about future growth and cash flows. I went back to that valuation, updated the numbers to March 23rd of 2021. And then I tried to see what would happen to the PE ratio of the index and the value of the index as I changed interest rates. And I looked at three potential scenarios. In the first one, I assumed that growth, I call this my neutral scenario, keeps up with my risk-free rate. In other words, as my risk-free rate goes from 1 to 2%, growth goes up by 1% as well. Think of that as your neutral scenario. In your benign scenario, when interest rates go up, growth goes up more than the interest rate goes up. So if interest rates go up by 1%, growth goes up by 1.5%. And in the malignant scenario, growth lags increases in interest rates. You can see the consequences. When you look at the malignant scenario where growth lags the change in interest rates, you see that PE ratios are much lower. In the benign scenario, PE ratios are much higher. In fact, at the level of the S&P 500 was this morning, the only scenario where I get ahead of it is T-bond rates stay at 1% and I assume a benign scenario. That's what I've meant through this year when I've said markets seem to be having a very rosy picture of what's going to unfold over 2021. But if inflation is driving interest rates up, you're more likely to see the malignant scenario than the benign scenario. So think of the benign scenarios are more likely to be occurring if you have real growth driving interest rates up. But it's inflation, you're far more likely to see the lower values for the index. So will interest rates affect stocks? It depends. It depends on what causes rates to change. I know right now people are expecting the economy to come back with good reason. But people are also worried about inflation with good reason. Now, I know there are some who believe that the Fed can keep inflation down and rates low. I don't have that much faith in the Fed being able to keep inflation at whatever it wants it to. I'm old enough to remember when inflation got out of control and how much trouble central banks had to bring inflation back under control. So I think for the foreseeable future, you're going to see this dance driving stocks. When you see real growth be the front page story, you're much more likely to see stocks go up. When you see inflation be the front page story, you're more likely to see stocks go down. Now, one or the other of these forces is going to be vindicated as the numbers come out. And we'll just have to wait to see which one will be the dominant variable over the rest of 2021. As rates change, of course, the overall values of equities change, but different types of companies can be affected differently. And to understand why, I'm going to go back to a construct that I find useful to recognize why different companies face different challenges. It's a corporate life cycle. You got young companies, you got teenage companies, you got middle-aged companies, you got old companies. And one way to think about why this matters is young companies will tend to have negative cash flows. Why? Because their business models are in flux. They will have to reinvest a lot of money to create growth. Those negative cash flows are a feature, not a bug. And as they mature, those cash flows will turn positive. File that away, even though you might say, who cares? The other way to think about young and old companies is to think about where they derive their value. I have a construct I use in my classes called a financial balance sheet, where I argue that every company gets its value from investments it's already made, assets in place, and investments people expected to make in the future, growth assets. Young companies get all of their value from growth assets, and mature and declining companies get all or most of their value from assets in place. You're saying, so what? Think of the effect of rising interest rates. When interest rates go up, the value of growth assets for every company decreases across the board. But if you're a mature company, growth assets are a much smaller percentage of your value. Put simply, increases in interest rates will have a more damaging effect on companies that get more of their value way out in the future from growth assets. To illustrate this, I actually took a hypothetical example of two companies. It's very simplistic, and here's what I did. I have a mature company that grows at a rate 1% above the risk-free rate, a growth company that's expected to grow at a rate 10% above the risk-free rate. Everything else about these two companies is identical. They earn the same return on equity, so basically same quality of investments, same risk and cost of equity. And I've tied everything to the risk-free rate, and I look to see what would happen to the PE ratios of these two companies as I change rates from 1% to 4%. Now, for both types of companies, as I raised rates, PE ratios decreased. But they decrease more for growth companies. Again, for the intuition is simple. It's because they get more of their value from cash flows way out in the future. In fact, one way to think about this relative effect is to compute a growth premium. Computed by looking at the PE ratio for the growth company versus the mature company, that number drops from 68%. That's the PE ratio for the growth company is 68% higher than the PE ratio for a mature company when the rates are 1% to 55%. And this is assuming a neutral scenario where growth and risk-free rates move together. If I put in the malignant scenario, the divergence gets even bigger. If I have a benign scenario, the divergence gets smaller. So everything we talked about, inflation and real growth, kicks in here. If interest rates continue to go up for the rest of 2021 and it's real growth that's driving it, I think growth companies survive and hold on to value. If it's inflation that's driving it, you're going to see growth companies suffer relative to mature companies over the rest of 2021. So here's the bottom line. I know that for many people, as they've looked at markets this year, they wondered, how can stocks continue to go up as rates go up? And I think the answer lies in why rates go up. And to do that, you got to abandon this Fed fixation, the notion that Fed sets rates, and think about the fundamentals that drive rates. I know many people dismiss inflation. They think of it as something from the past. Hey, trust me, inflation is never something from the past. It's true, we've had a few decades of keeping inflation under control. But don't get cocky. And this is really directed at everybody, including central bankers. Inflation is like that genie in the bottle. As long as you leave it in the bottle, it's okay, but it comes out, getting it back into that bottle is not going to be easy. So when I hear people saying, well, what if inflation goes to 3%? I think my guess is many of them are too young to have lived through an inflationary spiral. Nobody has lived in an inflationary environment ever takes inflation lightly. So the rest of 21, the big question is the one hanging over inflation, because it's going to drive everything else in markets. I hope you found this session useful, and thank you very much for listening.